Welcome back to the Bitcoin Layer. I'm Nick Bhatia, and today we bring back Matt Dines. He is with Build. Matt, thanks for joining us again.
Hey Nick, great to be here, and thanks for having me back.
Of course, Matt. We're having you on today to discuss rates, what's going on in Treasuries, what's going on the front end of the curve. Specifically, we want to know, is the Treasury market falling apart here or not? So we're going to go through a couple things, and we want to get your expertise. The first thing, I see you talking about the inversion in the bill curve. This is a nuanced part of money markets, but what's going on with 3-month, 6-month bills? Why is it important? And can you explain what quarter end has to do with any of this?
Yeah. So just to get started there, I think the leading question was, is the Treasury market falling apart? That's a tough one. We'll look at the chart here of the 10-year, the rates, the long end. It has not been a pretty, run here for the last 3 years for the bond bulls, if you will. But is it falling apart? That's a hard one to say, but we're in the middle of a pretty violent cycle, and that's been apparent since, I'd say, late 2020 if you were watching closely, but it's just accelerated. Now from here, I think we're at an interesting point as you look into quarter end. Quarter ends are always kind of a time where things come to a head in financial markets. This is the time where all of the public entities, the banks, whether it's the large primary dealers, the JP Morgans, the cities of the world, down to the regionals that have had a lot of trouble flaring up so far in 2023, to the broker dealers, to just everybody involved in the system. This is where you got to come through and prepare your books to look solvent, right? And so this has been we'll go and talk about the 10-year and the long end and what they've been doing, and they've had a lot of problems. But you can also look at the front end in the bills portion of the curve, the money markets, if you will, to see where the pressures are really springing up in the system, versus the long end is going to tell you a lot about where the long-term investors with the 10-year, 30-year balance sheet capacity are seeing rates and kind of the preservation power of bonds themselves, but also real growth and inflation expectations in the economy. But if you're looking at these Monday auctions, right, and there's two key ones that I like to follow from a week-to-week basis that come in, the Monday and the Thursday. Every Monday morning, like clockwork, every week, you have a 3-month and a 6-month bill that go into auction. They've gone up in size since we've got out of the debt ceiling impasse in June. So they've raised them. I think they're about $65 billion a week. They're going to add another $2 billion next week. I think I just saw announced yesterday. So every Monday you see a 3-month and a 6-month bill go off, and the auctions come on like right at the same time. So you get a good measure of the system's capacity, where it sees the demand for basically the short-term Treasury IOUs without duration and credit risk in the system. And then you've got on Thursday afternoons, technically morning here, I'm on the West Coast, so they come in the morning, but you get the same thing, but the 1-month and 2-month bills. So it's even a shorter term look, if you will. So the Monday, I think, is pretty special because it gives you enough time frame between those two checkpoints on the front of the curve where you can start to really see some slope coming into play and where the system sees itself going. But the 1 and 2 month, they're just so close and so front end. That's where you really see emergencies start to happen, like pressure building in the system. So for example, in March, you saw the low rates on those 1-month and 2-month bills. This is for if you have some overlap with, let's say, like Jeff Snyder's podcast and that stuff, like you saw just a ton of demand rushing into the front end collateral. Basically you were seeing like 0% bids, just bids at par for Treasury bills, like the rush of flight to quality for that collateral in the system.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today, or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today.
What we're seeing now in the 3 and 6 month, and you can track this in this tweet. This is my one tweet. I just make sure I get every Monday, what happens in the 3 month and 6 month auction. What we're seeing in that specific auction lately is the return of inversion in those two maturities. So technically what we've been seeing since I think July 27th was the Monday this started, but we saw the 6 month begin clearing at yields below the 3 month. We've seen that for now, I want to say 4 weeks in a row. We repeated yesterday. So like clockwork, it just keeps coming in. And if you think about this in the kind of the big picture cycle of kind of supply, demand, and the money market and what this represents, what you typically see in the cycle is like as kind of pressure materializes in the system, like the banks, like these are all major financial institutions that are showing up at these auctions. So it's your big banks, both domestically and then internationally. It's a high degree of international financial institutions that going out and getting their dollar collateral at these treasury auctions every Monday, and that's the dynamic of what's making the supply or the supply and demand mechanics at these auctions is making that longer term bill. And longer term here just means 6 months. There's barely any duration on this bond. You're not going to see these big swings in price that you're going to get on a longer duration bond like a 10-year or 30-year, where you're seeing kind of the big losses that have materialized in the bond complex. You're seeing more demand now flooding into that longer maturity at the bills curve, which is saying basically there's a flight into safety, like to bid those back down. So that's the kind of the point in the cycle we're at, where we've seen it twice now. You usually see a run up, and this is that chart I post on Mondays. You usually see a run up of this happening as a hike cycle matures. It gets to peak terminal value, if you will, for Fed funds, or how high can we hike rates? How much can the system technically absorb? And you'll see this inversion appear, and then you always, like clockwork, like the last $3 cycles where we have solid data on the terminal. What you'll see is a let up in the inversion. So it'll renormalize based on some sort of easing event that looks like it alleviates the pressure in the curve. And I'll go through and say like what those have been with some examples, starting with this cycle and in the past. But usually what happens is that first event doesn't actually clear the pressure out of the system, and you see a return to that inversion, and then you just keep going, and then you have to get the pressure out of the system again. So that's kind of the standpoint of what we can talk about. But since July 27th, we've seen that second appearance of inversion at the front end of the curve. That's been accompanied by the 3 month bill and like the collateral yields coming, or repo rates coming below the 3 month yield. So there's no free lunch, there's no free lunch now to go out and go pick up your collateral for at a yield or at a price cheaper than what it would cost you to go in and borrow more dollars in repo. So all of those free dollars have been sucked out of the system. They're vacuumed out, which it amounts to a few basis points, but what it amounts to in the system is just millions of dollars on each T-bill issues. That's just kind of there for the grab for the financial system to go in and just get more dollars flowing in. That's disappeared, since July 27th, which means it's got to go somewhere else. That pressure has to go somewhere else, and that's where we don't know what that next event looks like, but there has to be some sort of trigger, if you will, some weak point in the system that causes that pressure to ease.
Okay, so let's break this down for the audience. What we have, and let's take a look at this chart here. What we have is the number of consecutive weeks that the 3-month, 6-month bill curve is inverted. What that means is when a 3-month, 6-month bill curve is inverted, it means the yield on the 6-month bill today in the auction, as Matt is saying, it's Monday auctions, the yield on that 6-month bill is now coming in below the yield on the 3-month bill. And in a hiking cycle, you would expect this slope to be positive, in that the 6-month yield should give you more money, more return than the 3-month yield, because you're holding it for longer, and as rates go up, you should, in theory, make more money on the 6-month bill than on the 3-month bill. But now it is inverted. It inverted in March when we had a regional banking crisis. And why did it invert at that time? Because now you think that cuts are coming, so you'd rather own the 6-month bill than the 3-month bill and lock in that yield in anticipation of cuts. But that scare resolved itself. The curve uninverted, became normal again, and now we have a re-inversion where 6-month bills are once again lower than 3-month bills. That is an inverted curve. It's either for one of two reasons, is what Matt is kind of saying here. One of the reasons is that something is going to happen over the next 6 months that actually causes the Fed to go into cuts. So some traders are trying to lock in that 6-month bill today. It's either that, or there's some dynamic around window dressing, which is what he's saying when you try to make your balance sheet look pretty at the end of the quarter or the end of the year. So maybe there's a December 31st dynamic in which investors want to own the 6-month bill today, secure that collateral for their own books, so that it matures after the new year and in 2024, so that on December 31st it's still on their books. If they buy a 3-month bill today, it's going to mature in November, and you might have to have an additional collateral scramble to go get some instrument for your books to make it look pretty. So that's the breakdown, that's the background here. What Matt is saying is that something is up. 6-month bills inverted to 3-month bills is not normal. And then looking at the chart here, it actually only happens before things start to go bad. And each time that it's happened, you see this inversion, and then it relaxes, and then it comes back when investors realize, oh, wait, things probably aren't okay. And that's where we are today. So we're in the 4th week of inversion once again on these auctions. And it's an important trend to watch. So Matt will be definitely staying with you as we go. Now, I want to shift a little bit to the longer end of the curve. On this chart, you have the 10-year yield peaking up above the highs that we had last year and back to a decade and a half high on the 10-year yield. So what are you seeing on the chart? Is this yield about to go toward 5% as we break out here? Or are we coming up against some levels that you feel buying might actually come back into the market?
So, great questions. I wish I knew with certainty which way it was going to go. I'll say this. So it looks like if you're drawing the lines, on the post-2008 channel, it is starting to look more and more to me like the bears are winning, and we've been in a secular bear market since, let's say, post-2008. That's not for certain, though, because as you kind of see the green lines moving from top left to bottom right, those are the channels. I've drawn in just to guide, my trading and understanding where the market is at for duration, yields, etc. You still see a couple of channels of support for the bid on Treasuries, but those lines are coming from a long time ago. Those are coming from 1981 to 1984 peak Volcker. So that's the point where the bulls on yields, bond prices up, yields need to come down. Those are the last kind of like rungs of support that the bulls are counting on. So if we break, there are two very light lines there. If we break those lines, because you can kind of see this run the bears have been on since mid 2020, right? We've just gone from the way below the bottom of the channel. I'd argue that the monetary policy actions of Q1 2020 at peak, COVID panic, we definitely pushed way too far at that point and pushed way below the channel of where the lines even looked like they should go. But it's just been this run from where we were then to where we were now. It's truly massive. I can't say that enough. How much ground we've covered in 2 to 3 years, and I think the kind of the level of drawdown and violence, historical return, everybody is kind of coming to a sense of that. But we're at the point now where we're hitting those levels of support, if you will, for bond prices. We have to trace back to not just like pre-2008 or pre-2001 or even like pre-Gulf War. Like you've got to go back to the Volcker peak hikes of 1981 to 1984 to find that support for the Treasury. Another way to think about it is kind of the pain line, if you will, of where the system could tolerate that level of yields before you get the bid to step in, before there's too much pain. And these are, people want to poo-poo like the technical analysis, too many lines on the chart, whatever. Some truth to that, but these lines line up on the chart for the reason, and that's because you hit a point of maximum pain for some party, and that's when someone needs to flip from a seller to a buyer.
The Bitcoin Layer is sponsored by Foundation Devices. Now, we all have talked about the dangers of letting your coins stay on an exchange. The importance of withdrawing your Bitcoin to self-custody is really part of understanding what Bitcoin is all about in the first place. Bitcoin is about avoiding centralized financial institutions, and with Foundation Devices, we are showing you guys an amazing device. It's called the Passport, and with the Passport, you can get your coins off of exchanges into custody with this beautiful, easy-to-use device. They also have an onboarding service that will help you get settled with your device, get comfortable with it, get to understand what it is like to actually take custody of your Bitcoin. So check out foundationdevices.com today and make sure to pick up a Passport and use the promo code BitcoinLayer for $10 off your device.
So on the sell-off, I'd say if we go much further from here, we're getting very close to the peak amount of pain on the financial system and debt capacity and just all the other boundary constraints that we were at the worst of the late 70s as that kind of fever in the monetary system was breaking. So if people want to ask, is the Treasury breaking? How much further does it have to go? At some point, the bulls need to step in here pretty quickly, and that's why from some sense I would expect that quarter end is a key spot for these things to happen. So we just went through the regional banking crisis. The Silicon Valley Bank situation appeared, I think it was Thursday, March 7th. So as you get into the end of a quarter, and spring and fall are key ones, just for seasonality reasons, we don't need to go into the whole deep dive there. But that's where you really start to see the kind of that easing pressure, some sort of event come into the system and take it back down. So these lines I've drawn on the chart, you can kind of see where the bulls have come in during this sell-off and won and actually come in and support the long end of the curve. Again, we're looking at the 10-year here, not the long bond. They'll behave pretty similarly. But you saw an initial kind of rush back in March or February, March 2022. Was it 2022 when the Ukraine situation happened and we just rolled over? I say that now because it feels like we're clearly in some sort of geopolitical war. And these situations take time. If you look at World War II, you're looking at the high points, low points in the chart. Like you kind of see the points where it looks like the Allies are winning the war, or when the Japanese have won a big event, something like that. That's kind of like my mindset of where we are right now. But you did see that flight to quality, a little tiny rally there in March of 2022. Then we immediately sold off. In June of 2022, we found the next support along a trend line, and that's when we saw the commodity complex roll over. So remember, we had just started hikes from the Fed, February or March meeting 2022. I can't remember exactly when the first one was, but between February and June of 2022, we hiked enough to get the commodity complex to roll over. So if you go back and look at like the oil chart or copper chart, all of those peak in June of 2022. And that easing in the kind of the input cost of commodities in the system was enough to make the bulls look like that, they'd found their channel, right? But you get into some support, bulls are winning, but then they would give it right back, right? And then the next point, the bear market takes another sell-off after Powell's comments of Jackson Hole last summer. We're at Jackson Hole right now. I think it's another potentially key event. And this is a chance where, the Fed has some window to telegraph, markets of where they'd like to guide them. We can get into that here and what might be around the corner this Friday and then through the end of September. But we saw after Jackson Hole 2022, you actually saw the dollar complex start to roll over, right? You see the DXY spike to, I think it was 115. That also went well outside of its historic bands. It even looks a little bit more bullish to me on the chart than Plaza Accords, peak Plaza Accords. I think it got up to like 140, 150 back in 1983. From the perspective of the hikes and how much of a squeeze was put on the system from a just tightening perspective, it looks to me like we pushed the dollar to the top end of the kind of the short-term channel post 2008 dollar bull market. That actually pushed the dollar outside of the bear bands, going back to this same period we're talking about here that we're hitting on Treasury support from the 1981 to 1984 era. That rolled the dollar complex over starting in October. We started to see that pressure release in the system, and you saw the long end start to come in as the bond market started to believe that this tightening, the dollar squeeze, et cetera, was going to be enough to, I guess, resolve the pressures in the system. Since July 27th, this reappearance of a bear market, the inversion on the front end, it looks like we're in to another one of those same situations where now we need to ease the pressure out of the system again. It needs to come from somewhere, but we don't know where it is. So I think that's the situation we're in here for the next 4 to 6 weeks till we get to the end of Q3. And I'd say, from my perspective, just watching headlines, watching the market action, there's no shortage of places that this could come from, right? It could come from onshore, like you could see the recession that, everybody's been calling for, I want to say like 2-3 years now. It's been long delayed, but that may be one area that could deliver this easing and support the bid for the bond market. It could come from offshore. So you're seeing a ton of pressure right now in Southeast Asia. I'd say would be the hotspot. You see all kinds of headlines coming in on China. So you had a large trust company, financial institution, Zhongring. This won't be a name that's familiar to Western market players, but it's basically kind of I would think about them in terms of like the variable annuity market or the fixed annuity market in the United States, just promise states of return. On the back end of those are credits, right? We can talk about that market in the United States. It's a whole nother can of worms. What you just saw in China, one of those just failed to pay out their claims, right? And so you've got I want to say like 138 billion in an asset manager here who's written these fixed annuity products, who has just missed those payments to their end investors. So what that's reflecting is like there's some mixed like credits on the back end that are experiencing distress, and this is where you see the other side of the coin in the property market in China with the country garden issue that's coming up. And so that could be one source of hotspot weakness, et cetera. And so we're just kind of watching, as market practitioners, just watching the Chinese yuan dollar exchange rate, all of the fixed support levels that the PBOC is implementing throughout their financial system. Could come from Japan too, or something similar. So that's a whole area to watch. Basically the whole point is like we don't know here what's happening, but it looks like we need to move to something to find the new boundary conditions, and then once we get out of that, we'll work from there. But I'd say like right now it's very touch and go. You're watching for the next 4 to 6 weeks, if you will, get through quarter end, and then we'll reevaluate later. But at this point in time, you're kind of seeing, there is somewhat of a bid coming in for 30 years. I kind of highlighted on this line. The next easing comes in. I'd expect them to come in and try to support that next blue line if this bear market continues. And I guess it just depends on where the system finds itself, after we get through the next 4 to 6 weeks on what happens more broadly than that.
And so if we had to put you on the spot, Matt, in the direction of 10-year yields, let's call them 4.5% today, because 4.5 would be at the new high of this cycle firmly, which as of right now, we're recording on Tuesday. This will air on Wednesday, 2 days before Jackson Hole, but let's assume that we've broken here and we're at 4.5%. Do you expect the buying to come in on global macro weakness and just a renewed bid for treasuries, or do you expect these higher yields to give way to themselves and the breakage itself is the treasury market? Just, if you had to put one way or the other 50-50, where would you say we are here in the treasury market?
How long by end of quarter, you think?
So let's say for the duration of the year.
Okay.
Looking at these lines and giving way, and is with the treasury market being broken, that's the question here. Are we going to see the bid come in, or is this breaking itself here? And I know you have the Ukraine war in the background here, and maybe that fits into your answer somehow.
Yeah, I'd say it looks like we're in a secular bear market in treasuries. Now the question is how far outside of those bands can you go before you cause too much pain and something needs to come in and support. So we're living right now, we're operating under a QT regime where the Fed through SOMA wants to force market participants to buy more treasuries, right? And that can be anywhere on the curve. But what you have seen, especially at the August auctions, I'll say this, I expected a rally stronger than, a better rally than what we got heading into the 10-year and 30-year auctions last Wednesday. So personally, that surprised me. I thought, we had a Japanese government bond auction on Monday. I could understand just the positioning, try to, this works through the yen, dollar, and all that, just through the financial system to set it up so that these sovereigns have, as low and efficient of a coupon as possible, because they're all over indebted, right? Everybody knows all the G7 is in a pretty tricky spot for the debt to GDP situation. So my point there is I was expecting better support to come in through the financial system, just through the financial system, all the money center banks, et cetera, to come in and support these auctions better last week. Japan didn't go that well. They had a 20-year, I want to say more recently than last Monday, that didn't go well. When I say it didn't go well, it just means it trailed a little bit. It wasn't a failed auction or anything. It's just you expected it to come in a little better. Treasuries were the same way. So the 10-year and 30-year, I thought they would be able to get a little bit more rally than we did. And it actually shows on the chart here. There is a green candle where yields came in front of the auction, but it's barely noticeable. So that didn't show up. So it looks like here this is a market where I think the bears are still in control. And so, that's a question to be seen, right? If we need to continue to run these deficits, and it looks like that's what the Treasury plans to do, based on the quarterly refunding statements they provided, right about when we saw the second inversion up here in the bills curve at the end of July. If they want to continue running these deficits, and that looks like the forcing function of this entire problem, this is probably going to continue. So I would expect the bulls to be able to, force some sort of rally here. There could be an event that forces yields to come in, but the underlying problems in the bear market still, to me, look like they're unresolved. So I would say, one more thing.
No, and the follow-up there is if the problems are unresolved, the Treasury supply is coming, the Fed isn't the buyer. I hear in the background what you're saying is that the bears are in control because the next easing is nowhere to be found, and I'm guessing you think that Jackson Hole is going to be used as an opportunity to push out, again, any expectation of the Fed coming in to save the day. Is that the setup here going into Jackson Hole?
So I'd say the setup going into Jackson Hole has changed quite a bit in the last 2 to 3 weeks. At first, if it was the end of July, and I was asking around, what do you guys expect for, what is the message coming out of Jackson Hole? It might have been we're going to give a lot of pats on the back for getting over that inflation impulse. But I think that's changed these last few weeks as it's become pretty clear that that wasn't the whole picture. That wasn't game, set, and match. That might have just been round one of the pressures facing the system. So I would say what I'm expecting, just based on, I have to hear this from the tea leaves because it's a small club that gets to go to Jackson Hole and I'm not in it. It's only about, I want to say 120, 150 people who actually get a sense of what's going on there. But in what you're seeing in the press, the headlines, etc., it sounds now like the messaging is going to center around higher R star, higher neutral policy rate, and what I take that as, that's just coded language for we're actually going to be dealing with a higher interest rate regime, which aligns with the bear market's messaging at the end of the day. That the era of a 1.25 30-year bond, issued in Q2 2020 over what I consider to be one of the most significant policy errors. What will go down as one of the most significant policy errors of all time in Fed history, that Q1 2020 monetary impulse. Those days are gone, most likely. It will take something pretty extreme to get back at that low end of the channel of what we saw then. So I would say going in Jackson Hole, it kind of aligns with the bear's message, surprisingly. As hard as it is to triangulate these and find where the boundary conditions are, it sounds to me like they're coming to the realization that higher for longer is, again, part of that messaging. And you're kind of seeing this in across all curves. And higher for longer may be consistent with some cuts starting, it could be as soon as Q4, could be 2024. You might get cuts, but you won't be able to go back to the zero bound, or don't expect a massive QE regime or support. That is despite, I was getting at this point earlier, we're living under a QT environment, but you can see it in the bills auctions, on the weekly tear sheets. The longer durations are getting more support than the front end bills. So right now, kind of the SOMA purchases, the rollovers going into bills. Let's say on a $65 billion bill auction, you're getting somewhere $5-6 billion in, from SOMA reinvested and rolled over. On the 10-year and 30-year last week, you'll just use the 10-year for a guideline. You had like a $31.6 billion auction. Maturity's coming due in 10 years, so that's going to live there for a long time on the balance sheet. The Fed had to come in and support that one with $8.6 billion in rollovers. So the ratio of how much SOMA is financing the longer end auctions, it's a lot bigger. We're talking a couple $2 to $3 billion than what they have to do in the front end, and it's much lower capacity as well. So the balance sheet capacity out 10 years out, 30 years out, it's not the same degree of front end, low duration risk, low credit risk that the system is for now just gobbling up. So yeah, I would say that the messaging at Jackson Hole I'd expect is that higher R starred is coming from like the Hawks camp, and then from the Doves camp you're seeing pressure on the entire idea that we need to raise the inflation target to from 2 to 3%, which you couldn't be at further extremes of the spectrum. I think if you're dividing those two camps and looking at policy, one end is saying let's just let go of the inflation target, and the other says like no, we're gonna set policy rates higher and rates in R star, just completely different camp. So right now, TBD who wins, but ultimately it'll be the markets who decide.
Matt, we'll get to discuss it in person in Austin on Friday together when the Jackson Hole headlines hit. Matt Dines, thank you so much for joining us once again at the Bitcoin Layer. Matt, tell our audience where they can find you online.
Yep. You can find me on, I would say Twitter, but now I guess it's X. My handle is @Build CIO. I don't know how much longer we have in these days on X. It seems to be changing so fast, but for now, that's where you can reach me.
All right, thanks, and we'll see you guys next time.
Thank you.
Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.